In this video, we're going to talk about how homeowners can get the most deductions possible so that they can maximize their tax refund. When tax time rolls around each year, many homeowners like to search for tax breaks. Luckily, there are many tax deductions for homeowners that could amount to several thousands of dollars back in your pockets. There are a lot of tax benefits to owning a home as long as you know what to look for. Let's take a closer look at which of the household expenses are deductible as a homeowner and consider whether you should take the standard deductible versus the itemized one. And I'm also going to give you the top 8 tax deductions associated with having a home in 2023-2024 timeframe. So stick around for those. Hey, what's up guys? My name is Chase and this is a penny pincher's guide to personal finance. If you like videos like this as well as other ones having to do with finance, then hit that like and subscribe button because we're going to be putting out more videos out in the future. So let's jump right into the first one. So before we dive into the deductions available for homeowners, it's essential to understand the differences between standard and an itemized deduction. Both types of deductions can lower your overall income tax burden by reducing your taxable income. Now, the Internal Revenue Service, or the IRS, makes the standard deduction available to all tax filers, and in 2023, the standard deduction breaks down like this. For single and married individuals filing taxes separately, the standard deduction is $13,850. For married couples filing jointly, the standard deduction is $27,700. And for head of the households, the standard deduction is $20,800. With the standard deduction, you can reduce your taxable income by a standard amount, and when you itemize deductions, including tax breaks for homeowners, you forego the standard deduction, and instead, the total amount of the itemized deduction will offset the taxable income and lower your tax burden. So if you're considering taking advantage of tax deductions for homeowners, then make sure that the total amount of your itemized deduction is larger than the standard deduction. Otherwise, you're going to be wasting money and giving more money back than you actually need to. So as you look into multiple other types of deductions for homeowners, you may come across some things that you might think meet this criteria. Well, there is a bigger list of ones that don't meet than ones that do meet the deductible criteria, but here's some of the big ones that do not meet it that a lot of people think will count. So fire insurance will not count, homeowners insurance premiums does not count, the actual principal on your mortgage payment does not count, domestic services associated with your home, depreciation cannot be deductible, utilizing your gases or your electricity or water does not count, and then your down payment also is not tax deductible. So with those out of the way, let's talk about the top 8 tax breaks, tax deductions associated with home owning in 2023. All right, so the first one, and probably going to be the biggest one for most people out there, is going to be mortgage interest. If you have mortgage interest on your home, you can take advantage of mortgage interest deduction, and you can lower your taxable income through the itemized deduction of a mortgage interest. In the past, how homeowners could deduct up to $1 million in mortgage interest. However, recently, due to the Tax Cuts and Job Acts, it has reduced the limit down to the first $750,000 as a single filer or married couple filing jointly. And if you are married but filing separately, the deduction limit is $375,000 for each party. Now, this can be a little bit confusing. You're not going to be able to deduct up to $750,000, but if you bought a home for $750,000, then all of the mortgage interest for that home will be able to be tax deductible. But if you were to say buy a home for $1 million, that extra $250,000 interest that you have on that will not be tax deductible. So this is a substantial amount that will go into your itemized deduction and help you get above that standard amount. All right, so number 2 is going to be the home equity loan interest. And home equity loan is essentially a second mortgage on your house. With a home equity loan, you can access the equity you've built in your home as collateral to borrow funds that you need for other purposes. So like regular mortgage interest, you can deduct the interest you've paid on your home equity loan and your home equity lines of credit. However, if you can only claim this deduction if you use the borrowed funds to pay for home improvements. So prior to the Tax Cuts and Job Acts of 2017, you could deduct the interest on these loans regardless of how you spent them, but now it really does depend on if you're using it to upgrade or to use it on your home that you currently have. So it does kind of restrict how much you can apply this deduction to your itemized deduction. Okay, so the next one that we're going to talk about is going to be discount points. When you take out a mortgage, you have the option to purchase discount points to lower your interest rate on the loan. And if you have this option, one discount point will equate out to about 1% of your mortgage amount. And if these points are purchased to reduce the mortgage interest rate, you can deduct the cost of the discount points on your itemized deduction for the year. However, loan origination points will not be tax deductible because these are fees that don't affect the interest rate of your loan. So it has to be a point that is affecting your interest rate and your total down payment of the loan to be applied to your itemized deduction for the year. Okay, so the next one is going to be property taxes. As a homeowner, you'll face property taxes at a state and a local level, and you can deduct up to $10,000 of those property taxes as a married couple filing jointly, or $5,000 if you are single or married filing separately. Depending on your location, the property tax deduction can be very valuable, or it can be very minimal depending on which state and the property taxes that are associated with it. Okay, so the next one is going to be on necessary home improvements. Necessary home improvements can qualify as tax deductions depending on what they are. If you're just upgrading your kitchen or your bathroom, then that will not fall in that. Now, of course, the definition of necessary is somewhat limited, and if you upgrade your fully functioning kitchen, those improvements costs may not qualify. However, if you have to make a permanent improvement to make your home more accessible for medical reasons, that should qualify. A few examples might include installing medical equipment, railings, or widening doorways for an accessible home. All right, the next one might not pertain to everybody, but if you do fall into this category, then it can give you a little bit more into your itemized deduction. And that is if you operate a business in your residence, you may be able to deduct some of that expenses of maintaining that space through a home office expense. The IRS requires that you use your home office for regular and exclusive business use in order to qualify for the deduction. And if you use this office space when it is convenient or just for working from home for your employer, then that will not qualify. But a lot of people, if they are self-employed in 2023 nowadays, doing a lot of e-commerce or online businesses, then having a home office will be a very common thing and can be going into your deductions. Now, in terms of deductions, the size of the deduction is based on the percentage of your home dedicated to the place of business, or there is a standard deduction based off of just having a home office that we've actually talked in a previous video if you want to check that one out. Okay, another big one that can go into your itemized deduction is going to be your mortgage insurance. Now, private mortgage insurance, or PMI, is another expense that many homeowners must factor into their budget. And PMI is there to protect your lender if you're unable to continue making payments on your mortgage, and that's if you are unable to put less than 20% down on your house. The PMI will be placed there, and then it could be removed in the future if you get above that 20% equity into your home. So this is a great deduction because you can deduct your mortgage insurance payments on your itemized tax return, and that does end up being quite a bit in the long run. Okay, so the eighth and final one that we're going to talk about is going to be capital gains. Capital gains tax breaks come into play when you sell your home for a profit. The capital gain is the difference between the value of the home when you bought it and when you sold it. And so, for example, let's say you bought your home for $100,000, and a few years later you sell your home for $150,000. With that deal, you walk away with a capital gain of $50,000. Now, if you use your home as a primary residence for 2 of the last 5 years, you could keep some of those profits without any tax obligation. Now, as a married filing couple filing jointly, you can keep up to $500,000 in capital gains. As a single filer or a married filer separately, each party can keep up to $250,000 of capital gains without a tax obligation. Now, the key here is that you've lived in that house 2 of the last 5 years. And with a big tax break on the table, it is important to take these rules that apply to the deduction seriously because the IRS can come back and take the money back. Now, the bottom line is owning a home comes with a suite of financial and tax benefits for homeowners. It's important to approach tax season as a homeowner with a careful eye on maximizing the value of the home. With potential thousands of dollars in tax deductions on the table, it's a good idea to add up your tax breaks and make sure they all make sense. Compare the sum of your itemized deductions to the standard deduction before deciding which option is best for your tax return. If you're a homeowner, then you should take some time to explore your tax deductions. If you need help tracking the details of your situation, it's recommended to speak with a tax professional to ensure that you're cashing in on all the tax deductions available to you. I hope this video gave you some good information and it's going to be guiding you in the correct way for your tax journey. As always, we here at Penny Pinchers Guide want to thank you for watching, and we want to remind you that we are here from your first penny to your first million. We'll see you next time.